Thursday, actually, since today is the last day of the week. Amit Jeswani is with us, founder and Chief Investment Officer at Stallion Asset Private Limited. Amit, great to have you with us here on the program. Thanks very much. Correct me if I'm wrong, but I remember a couple of interactions back, you said that you were buying Polycab. And this is when the price had corrected, etc. And I think it's back at the price from where it fell, Amit. So you've made good money for your investors. So congratulations first up. And if you want to comment on that particular situation, do you still own that position? And lately, what have you been up to?
Good afternoon, Prashant. Thank you so much for having me on your show. Prashant, yes, we do own Polycab. I don't think that position is done as much that I expected to do. I think picture abhi baki hai. And this quarter should be a very decent quarter. It was gaining market share very aggressively last quarter when you compare it to RR, Kabil, KEI, etc. Polycab is a hyperscaler and it's a market leader with growth north of 20%. So I would say that for FY24, like the upcoming quarter, this is what I expect. You should, if they don't have anything very wrong on the income tax problem, we should be back to new highs in Polycab. So it's still very cheap. I expect them to make 600, 650 crores of profit this quarter, 1800, 1850 crores of profit this year. The stock is still very cheap here. So I'm fairly bullish on Polycab. And what are we doing? Actually, we're just increasing our portfolio quality. So in a bull market, Prashant, typically to make some alphas, 5-10% of your portfolio goes down a little less on the quality curve. So because you want to expand your alphas, like last year, our alpha 35%. So we were on that melt-up mode. Our only goal was to expand alpha because you were in a very strong bull market. Right now, I would say that we think post-Fed, the breadth has peaked. The bull market is still alive, but the breadth, these are two different things. The bull market keeps going on, but the breadth peaks typically 6-9 months before the bull market. So the breadth has peaked and you want to up your quality curve of your portfolio and you want to keep making better portfolio choices. You want to be in more secular companies. You want to be more assured of growth. You want to be in market leaders only because you've already made a lot of money. No sense in losing money at all.
Right. So what does it mean when you mean that you are increasing your quality or improving quality of your portfolio? What names would they be? Essentially, the ones who are traditionally considered quality, or some who might not be, traditionally considered quality, but you think are quality? I mean, how do you define quality is what we are trying to understand.
For example, OFSS this quarter, the numbers, OFSS is Oracle, numbers this quarter was mind-blowing. This company is typically grown at 5% and you had a massive earnings beat. The valuation was too cheap for the stock to sustain. That is, if the growth stays at 5%, you don't make much money. But if the growth actually changes and becomes like 20% or 15%, you end up making massive amounts of money. But we've already made very decent money within the first 1 month. So I'm saying you still are on the higher side of the quality curve. You're still chasing growth. That doesn't change. Like we would be happy if Indigo comes with a block. That is one stock that we are eyeing very aggressively. If you see Indigo last quarter also gained market share across the crisis. This year's free cash flow should be 14,000 crores, 8,000 crores of PAT, and today's market cap is about 1,15,000 to 1,20,000 crores. The industry's terminal growth rate is 15%. So every year the industry will keep growing at 15-20%. And typically, if you see 20% growing companies in India, like a Varun Beverages now trades at 90 times TTM, Titan trades at 95 times. So I'm not saying that Indigo will ever trade at 95 times. It's not possible. But that's the valuation. Like DMart with 20% growth trades at 95p. So the markets have decided that consumer monopolies, and this is not me, this is the markets who have decided that consumer monopolies who can grow at 20% will now trade at 90 to 100p. But this is bull market valuations, of course. But this is how the market thinks, and you'll have to think. And if you grow more than the 20% level, and you have a large terminal value like Trent does, then markets will give you at least 100p or better.
Interesting analysis over there, because the market has rewarded some of these names that you mentioned in a big way. Aviation, well, let's see. But yeah, it's true that it is getting to a near monopoly sort of situation for a carrier like Indigo. Fares are going up. and crude oil prices have been largely stable. So take that point. Speaking of going up the quality curve, I don't know, whether you managed to dodge a couple of these bullets in the NBFC space. Because I remember our last chat, I think you do have Bajaj Finance in the portfolio. But look at the action, and these are specific capital market related entities, and one or the other business has been targeted by the Reserve Bank, JM Financial, IIFL Finance. What do you make of this? Because there was also a lot of chatter in the market about giving better valuations to wealth managers, for instance. Angel One has done really well. Novama Wealth has been on people's radar. How are you looking at the non-lending financials now, given what's going on?
So on the capital market, we've got three names in our portfolio. We have Angel One, who's gaining market share. Unfortunately, they came with a QIP. We've never understood why they came with a QIP, but we still have Angel One in our portfolio because very aggressively they're gaining market share. We expect profit will be near 400 crores this quarter for Angel One. So it looks very cheap, Angel One to us. The growth in the first 2 months, Angel One, the growth has been 100%, like on average, like 95, 100% in the number of orders. We typically we get very happy when we get 30, 40% growth companies. This is something else which is happening in capital markets. MCX should grow at 60, 70% based on the 2 months of data that we have. And MCX will start reporting profits this quarter. Nuama has done very well. In fact, Nuama's profit, the stock has also done very well. We've made decent money in no time. We just bought it like 1.5 quarter back after the demerger. The stock's done well. The growth of, if you see, even in the wealth management part, Nuama's growth has been 38%. Anand Rathi is at 30%. IFL is very less growth rate. So basically, Nuama is still the fastest growing company in the wealth management space, yet the cheapest. MCX should get re-rated. MCX, we expect about 500 crores PAT next year. And you can keep tracking monthly data and make your decisions based on data which is coming. So capital markets, we are still very bullish. Capital market cycle started in September, October this year. Typically, cycles are 18 months long. Let's see, we can go wrong also, but we have a location. We have about 16% of our portfolio in capital markets. On NBFCs, we have about 8 or 9% of our portfolio in NBFCs. It's been very painful having 8-9% in NBFCs. We've lost alphas. But it is what it is. You can't expect. It started with Bajaj Finance. It then went to Paytm, then IIFL, then JM. So these are first of a kind. Like only yesterday, I was out for dinner with NBFC a CEO, and he was just saying that these are things which are unexpected, and even they have become a little scared about what is happening.
I think you last time we spoke, you said you own Bajaj Finance, of course, Arman and Five Star as well, right? Some of the others in that space.
None of them are doing well. So,
did you guys go Dutch or did you pick up the tab? Or did they pick up the tab? I'm just joking. Dinner?
Sorry?
No, nothing. I'm just kidding.
Who paid for the dinner is what he's asking.
The NBFC CEO dinner, Amit, is what we're wondering.
I didn't pay for the dinner. I'm already paying a lot of money for the stock prices. So
absolutely. Okay, now on a serious note, so like Polycab, right? There have been other accidents as well in the market, Amit. You look at hospitals, there have been sharp drawdowns. NBFCs, of course, we sort of discussed. Gas companies, city gas distribution companies, again, sharp corrections here. Now, not all need to work out like Polycab, but any interest at all in any of these names, in any of these sectors where there is a big difference in how the market perception is going, and the underlying state of the business, which may be different?
Actually, hospital is a massive terminal risk. If the Supreme Court and regulatory risks are today the biggest risk that everyone's worried about. And if anything, if the Supreme Court does what it's saying, then this will be a massive terminal risk for hospital stocks. And we had one hospital stock, which was Narayana Hrudayalaya. We sold Narayana Hrudayalaya this quarter. Because the growth was 6%. And for us, we've got just so many opportunities. We cannot take the 6% growth. It's very tough for us to handle 6% growth and then sleep in the night. So we removed Narayana Hrudayalaya. We bought one Ayurveda company, very small company, but our like hospital is one space where you have terminal risk, and I would wait for this Supreme Court judgment to get cleared before betting big on hospitals. It's okay if you buy 10% higher. The best-in-class guys, everyone knows it. It's Max, Medanta. Those are the guys you wanna like. These are guys who know how to execute, make it large, and these are the guys who I would buy if things are okay. In next 1-2 months, you'll come to know everything. Supreme Court has given only 1 month's time for the government.
Just wondering if that Ayurveda company was Kerala Ayurveda as well, very small, just about 300 crores market cap. But, you know, finally, I wanted your thoughts on these new age companies, because I remember you did sell Paytm, you continued to hold Zomato. Is anything in that space looking attractive? Delivery, a lot of people believe that, you know, the operating leverage will come by for them.
Delivery this quarter was good. We have only two names, Policy Bazaar and Zomato. They are about now 15%, 16% of our portfolio. These stocks have done very well for us, and we continue to own them. See, Zomato, this quarter growth was 69%. Policy Bazaar growth was 40%. I'm expecting next quarter Zomato growth to be 81%. Policy Bazaar Q4 is the strongest quarter. Policy Bazaar already turned PAT positive this quarter, and Q4 is the best quarter. So you want to hold them. You want to enjoy the ride. See, Mangalam, these are market leaders or duopolies. Our patterns of investing is the same. We want the highest growth. If we buy Trent, we want the highest growth. In QSR, you track consumers so well. You see Devyani, Jubilant, Best Life, they're all growing single digits. And you've got one player, thanks to Blinkit, which is now growing at 70-80% in the consumer type companies. These are unreal kind of, and at scale. When you have such kind of opportunities where Polycab should grow at 35% this quarter, Trent at 50%, those are kinds of bet where you can make sizable money. And it's not like we bought, all these are already up 2, 3, 4x for us. We are just riding the trend. Until the time they keep
hence the question on delivery, because in a logistics industry where, you know, there is not a lot of growth, delivery is the one which is the fastest growing.
Yeah, but for me, the minimum growth standard today is 30%, because I've got alternates which are growing at faster rates. So except Mankind and, you know, things like which are completely defensives and part of our portfolio, my minimum growth standard for me to now invest, because India is growing so well. And when your nominal GDP is growing at 14%, and we need only 20-25 promoters who are creating monopolies and growing at very high rates. When you get those kind of promoters, is only then we buy. We are growth investors, and we need consumer-facing growth companies who are market leaders, high ROC at reasonable initial valuation. And then we keep riding till we have a better alternate. Like if DMart, we used to have DMart in our portfolio. Now also we have 0.5% weight. And we sold our DMart to buy Trent, because DMart grows to 20%. 18, 19, 20%. We are not interested in 18, 19%. From selling DMart at 4,000, 4,200 levels, we bought Trent at 1,200, 1,300 levels, because Trent was growing at 30, 40%. And today, Trent and DMart trade at the same price. Tomorrow, if DMart grows at 30%, we'll add DMart and probably sell something else which is not growing in our portfolio. We will always be in good quality companies, and we'll always be in the highest growth of that sector.
All right, 30% is a North Star for Amit. That's
30% high ROC, good promoters, and you know, monopoly in the business. It has to be consumer facing. That's like, he could have asked for some stars, some moon, and
but you know,
on the side.
I would say kudos to him, because we've been looking at the portfolio, and you've managed to dodge a lot of the bullets. You've got a lot of the hits, including Trent, including Angel One, and, you know, so many of the other stocks that we've discussed. So kudos to your team.
He's not dodging bullets. He's the one firing the bullets.
So, yeah.
Amit, great to speak with you, Amit. It's a pleasure as always, and you know, lovely chat. And thank you for that perspective across a range of businesses. Thank you. Well, Amit Jeswani of Stallion Asset with that perspective. 33 points higher on the Nifty. We are at 22,500 plus as things stand right now. We'll take a quick